I'm not really seeing the economic boom that others are talking about. But that's because they're not in the either they're not in the line of fire from deficits, or they're not in the line of fire from private sector capex spending on AI. If you're in the orbit, or at least next to the orbit of those two things, you're probably feeling okay. Whereas if you're not, there's this whole array of other sectors that some of them are in outright recession. I mean, commercial real estate, or even like residential real estate, anything that's related to like turnover volumes, um, is recessionary. It's a very problematic industry at the moment. So I would look at things really on a sector by sector basis.
Hey guys, welcome to Everyday Finance. The federal government shutdown in the United States. 2025 could be an indication of a more significant change in the way the American economy functions. It's not just another episode of political drama. The flickering of a nation's systems is a much more serious issue than a single family losing power. When a shutdown ceases to be newsworthy and turns into a significant macroeconomic threat is the actual question. Lyn Alden provides a longer-term, more comprehensive viewpoint on this. The key economic indicators may hardly shift during the first month of a shutdown, she explains. However, the damage becomes apparent when it continues into the second month and strain mounts on social programs, food aid, and vital government services. Furthermore, this shutdown may expose more serious vulnerabilities than any previous one because the United States has limited historical experience with shutdowns this length. Alden's analysis demonstrates why this shutdown can be considerably more significant than the headlines indicate for investors attempting to comprehend how this moment could impact real money, real portfolios, and the trajectory of macro markets.
Yeah, so I wrote about this about a month ago, right when it was about to start in one of my research reports. And my view at the time was, for the normal length of a shutdown, it's not materially affecting any of my macroeconomic assessments. That's not to say that it doesn't affect individual people's lives. So it doesn't want to. I don't want to come across as like insensitive when I say that. But just from the big numbers I look at, the things I'm going to invest in, that kind of first month of a shutdown is not a huge macro scale thing. And now, as we enter the second month and we start to get into news about like food stamp programs and stuff running dry, that's where the game changes. We don't, like you said, this could be the longest one. We don't have a lot of precedent for how a shutdown could impact things after we get into this, like, when you start to get kind of deep into month two. I still would put probably the social aspects higher than the economic aspects, in the sense that, when you kind of impact that lower income segment, it doesn't necessarily show up super quickly in some of these big numbers right away, because, as many people know, like if you look at the top 1, the top 10, the top 30% of people in terms of income or wealth, they do a really big lion's share of the spending. So when you impact that 20 to 30%, it doesn't necessarily impact all the big macro things right away. But it does, of course, contribute to social tensions because it's still a pretty big percentage of the population itself. And so I still wouldn't put this next 2 to 4 weeks as super macro impactful, other than that it's more socially impactful, and that is a part of macro these days. And then there are many other kind of indirect things. I mean, there are SEC things that are delayed because of this. Arguably, flights are impacted by this because we already have a very tight air traffic control system in terms of labor. And so it's like you don't really have a lot of like to work from there. So around the margins, impactful, but just it's not as quite as big as some of the other things I'm watching. But the longer it goes on, the more it actually does become material. I do think that they weigh against each other significantly, and that's one of the key things that makes this whole cycle different than prior cycles. So like, kind of going back to my prior point, if you saw PMIs this low, like at or below 50 most of the time for quite a while now, especially the manufacturing one, for this long, or the yield curve inverted this long, or kind of rates this high and suppressing. If you look at, say, bank lending activity, how long that was suppressed. If you look at senior loan officer surveys, so like the tightening of bank credit that happened, especially throughout 2022, a lot of these things would, in their own, especially a collection of them, would point to a recession, which then we didn't have. And so one of the characteristics of like fiscally dominant economies is that they in many cases look more like emerging market recessions or emerging markets stagflations, which is to say you don't necessarily, it obviously depends on the market, but you don't necessarily have a big like unemployment wave, but everyone feels kind of poorer, or at least a lot of people feel poorer, and they're not 100% sure why. It's some combination of debasement, rising costs, uh, lack of kind of tangible growth as far as they can see, and they might see in the numbers that there's bigger growth, and like, well, I'm not seeing it in my life. Um, and so you have that, like if you look at say 2022, if you look at the misery index, so the sum of inflation, price inflation, and unemployment, the misery index reached recessionary levels, but of course that was mostly the inflationary component. And if you look today, the misery index is pretty much it's not low, but it's in check. You have kind of that mid-level inflation, fairly low unemployment still, and yet consumer sentiment is back near record lows because you have this kind of slow affordability crisis happening. It's not any sort of acute thing. We don't see like an acute spike in initial jobless claims, but we see this kind of lack of satisfaction with, say, college graduates getting into the job market, especially in the world of AI, and just generally a lot of sectors slowing. There's a lot of trouble areas in, say, whether it's private equity, whether it's venture, whether it's private credit, commercial real estate. Obviously, that's a surprise to no one. All these areas are on the weaker side, and yet it's offset by rather large deficits, which are not targeting kind of that high impact sugar high type of thing. They're not going out to people with the highest propensity to spend, but they are hitting that kind of upper older portion on average. Of course, some goes to the, like Medicaid and food stamps stuff goes to the lower end, but the part that we're talking about is mostly going to that higher end. But then that does trickle out through their children, through their employees and things like that. It kind of gets out there. So it still is a stimulus force, but it is that very K-shaped aspect to it. So you get rising polarization, you get things running hotter for longer than you'd expect, while you keep seeing cracks under the surface, and all the bears are kind of like, why hasn't things broken yet? And it's because these are all against this really still large fiscally stimulus force, even though it's smaller than the slightly smaller than the fiscal force last year. Yeah, I think another way of looking at it is a sector by sector basis. So whether it's real or nominal or sector by sector, I do think that this is an environment we want to slice and dice it. Perhaps a similar example is Canada, where when you look at the per capita metrics, that really mattered compared to the national metrics, because you had for a while a pretty high rate of immigration. And of course, what people feel is the per capita statistics. If the economy is growing, but above average rate of it is population growth, that doesn't feel like growth on the individual level. And I have when I sometimes analyze the economy of Egypt, because I spend part of each year there. They've had pretty high population growth. They often point to pretty high, even real GDP growth, the way they report it. But one of the metrics I look at there is energy consumption per capita. And that's been kind of flat to down for a decade now. And that coincides more with like on the ground what people feel. Similarly, if you look at things like how many of their labor hours does it take to afford the same car that it did 5 years ago, it generally takes them more hours rather than fewer hours to afford that car, which makes them feel like they're going backward, which is pretty realistic in many areas. And so when you kind of apply those similar types of metrics to a developed market like the United States, I think you get similar pockets where, again, PMI activity is low. So if you work in multiple different industries, the respondents or the employees there are saying, yeah, business isn't necessarily great. I'm not really seeing the economic boom that others are talking about. But that's because they're not in the line of fire from deficits, or they're not in the line of fire from private sector capex spending on AI. If you're in the orbit, or at least next to the orbit of those two things, you're probably feeling okay. Whereas if you're not, there's this whole array of other sectors that some of them are in outright recession. I mean, commercial real estate, or even like residential real estate, anything that's related to like turnover volumes, is recessionary. It's a very problematic industry at the moment. So I would look at things really on a sector by sector basis.
According to Lyn, key economic indicators like GDP, credit flows, and corporate earnings hardly fluctuate during the first month of a government shutdown. A false sense of security may result from that stability. However, the real pressure starts when the shutdown lasts for a second month. Lower-income households are initially impacted as vital programs like SNAP, food stamps, regulatory procedures, and labor-related services begin to disintegrate. Although these strains don't immediately appear in headline data, they are a warning of more serious structural deterioration. This brings up Lyn's main argument, which is that political dysfunction and financial strain are more important now than they were in past cycles. She then turns her attention to the less obvious aspects of macro, such as central bank balance sheets, debt servicing, and liquidity circumstances. The way government funding and central bank operations respond as the shutdown continues, she said, is a better indicator of systemic stress than consumer spending or unemployment statistics. Lyn goes into greater detail in the following section about what happens when the shutdown lasts longer than a month and why it might force lawmakers to take a different approach.
There is the challenge, of course, is there is an opaqueness to it to some degree, and so there's different estimates that have to be done. I do think that's a meaningful component. I wouldn't overstate it because the stock of immigrants over years and decades is a much larger number than the flow of immigrants in any given year. So we have had a complete halt really in that flow. The stock is still high, but as around the margins, those numbers start to matter. So when you see overall kind of payroll growth slowing to sub 1%, and then you combine it with that tighter immigration environment, that is, I think, a tightening in the labor force. So we don't really see it in unemployment rates so much yet. You see, of course, an uptick from the lows, but it's still, by most metrics, pretty low. But when you have that more opaque component that is not really adding on to that to the same degree, and that's kind of, it's diminishing. I do think that is letting off some steam from that and tightening things. And I do think that we're going to be in an environment of, on average, prices and price growth remaining above trend. I think some of the, like going back to the PMIs, prices paid going up even though activity is weak. So far from the tariffs, we've seen companies themselves try to absorb as much of that as possible to retain market share, and with the hope that they'll be temporary. So as they kind of pass through, they don't try to make permanent changes yet. But the longer they go on, especially for lower margin industries, they start to have to price. They start to have to push some of the costs onto consumers. So I think that as we look out a couple quarters, that'll be contributing to price growth. Now we have some disinflationary areas elsewhere, but generally speaking, I think the Fed's going to be stuck with this kind of mildly above target inflation, even as they're cutting and even as they're going back to a kind of mild balance sheet expansion. I think a handful of cuts are warranted, but I think the much larger problem is that the entire hiking cycle and then this cutting cycle is kind of separate from the core issue. So like for years now, I'm pointing out that the key driver of this inflationary spike we've seen has been fiscal. That's been the biggest source of it. Of course, the Fed partially enabled fiscal by monetizing a lot of those bonds, but the main driver was that fiscal decision. You of course had temporary supply bottlenecks, but they largely resolved themselves, and so the permanent price increases we see are largely due to monetized fiscal deficits. A lot of people, when they have this inflation fighting framework, they think of the 70s. They think of Paul Volcker. And the issue there is that the majority of money supply growth back then was not from fiscal, even though there was a fiscal component. It was from bank lending. And that's because demographics were very different then. Baby boomers were entering their home buying years. So you had kind of peak rates of bank lending, credit formation in that period, combined, of course, with oil shortages, all the geopolitical issues that led to that. So you had that supply side constraint, and then you had above average bank lending activity. So by drastically raising rates, Volcker did a couple things. One is he slowed down that bank lending, and two, he strengthened the dollar, which then it crushed dollar indebted emerging markets around the world. So it reduced their commodity and oil consumption. Brutal. So it relieved that supply side while also slowing down to some extent the demand side in the U.S. And that fought inflation. The problem is when you have fiscal driven inflation, if you raise rates, you're slowing down the private sector borrowing. But that's just offsetting the fiscal side. You're not slowing down the fiscal side. If anything, you're mildly accelerating the fiscal side due to the interest expense component we talked about. And so if you look at the data, bank lending has been pretty weak for a while now. It's starting to wake up a little bit, but especially throughout 2022, 2023, bank lending was very weak. That was never the source of inflation this entire cycle. So they're kind of targeting the thing they can. Their tools are mostly based around that bank lending channel, and it's just they're doing this almost because they have to. And so as they ease, you'll probably see a slight uptick in bank lending activity, which can contribute to economic growth and price inflation, money supply growth. It'll slightly alleviate interest expense, particularly on the shorter end. We'll see what happens with the longer end. But basically, it's kind of like the minority issue at this point. The biggest issue is fiscal. And if I were to criticize the Fed in one way, because I'm on the record saying that there's not a lot they could have done. One thing they could have done is that during the bottom of COVID, Powell came out and outright said we need more fiscal. It was a rare case of them willing to get somewhat political and saying our tools are insufficient. We need fiscal has to address this. Whereas he's been more reticent to say it on the other side. So it's a somewhat asymmetric willingness to critique the fiscal side, or at least draw attention to it to say, look, our tools are somewhat limited because our primary tools are not the key things. And I think part of why they do it is because they don't want to lose market confidence. If they say a lot of this is just outside of our control, that can spook the market. So they have to kind of overstate how much control they really have, even though it's the fiscal side that is the majority of the issue.
The first part of the segment examines how investors might use services, like a trust capital, which provides new premium custody accounts and self-directed IRAs. To protect cryptocurrency gains from taxation, the allure is straightforward. Trade popular cryptocurrencies, as well as gold and silver, while lawfully avoiding or postponing capital gains taxes. The pitch highlights that you may retain more of your gains compounding rather than losing them to the IRS thanks to 24/7 trading, cheap costs, and secure custody. With the given promo code, new users can additionally get a $100 bonus. The true lesson, however, is not only about tax efficiency, but also about getting ready for a possible macro shift. We're not referring to a temporary decline if the current government shutdown in the United States turns into a more significant economic catalyst. Expectations regarding growth, deficits, coordination between central banks, and even currency stability are about to be completely reset. Assets like Bitcoin might attract more attention as alternative value storage outside of established systems in such a setting. According to Lyn's thesis, we might be about to enter a period of fiscal domination in which the typical economic shock absorbers deteriorate and policy restrictions to become more stringent. This does not imply that investors should enter transactions hastily. It entails remaining vigilant, recognizing the areas where pressure is increasing, and keeping an eye out for the first indications that the shutdown has progressed from tolerable to critical.